Welcome back, everybody. President Biden's tax plan could be a triple threat to the real estate market and to investors. Robert Frank joins us right now with that story. Hi, Robert.
Good morning, Becky. Biden's tax plan would hit both residential and commercial real estate because of three big tax changes. First is the elimination of so-called 1021 exchanges. Those allow property investors to roll their gains from one investment property or the sale of one property into another without paying any capital gains tax. Under Biden's plan, they would owe a capital gains tax, and that leads to the second, which is the capital gains tax would jump from 20% to 39.6% and would apply to the sale of real estate for those making more than $1 million in any 1 year. Now, keep in mind, sale of primary residences, you would probably still get that exemption of $250,000 per person or $500,000 per couple. And then finally, there's the elimination of the step-up in basis. That would hit inherited property. So let's say if you inherit property, you would pay a capital gains tax on the gain, even if you don't sell it. But again, only if your gain and your income for that year is over $1 million. The real estate industry already fighting these changes. The National Association of Realtors coming out, sending a letter to Treasury Secretary Janet Yellen saying the proposals would reduce growth, shrink affordable housing, and penalize many hardworking and enterprising Americans who have spent their lives saving and building equity in their properties. So, guys, the industry lobbyists already out in force to fight these measures.
Hey, Robert, some of them, these changes seem like they might make sense. Others seem a little more punitive. And I guess it always, your view on these things always depends on where you sit. But the 1031 in-kind exchanges, that seems like a bit of a sweetheart deal that maybe has allowed this industry to do very well. When you're talking about individuals who sell their house, maybe that they've owned for 30 or 40 years, if they make more than $500,000 on that, they'll pay this heightened double capital gains tax, essentially. I mean, that seems like it's something that would, again, hit many of the families in these coastal areas that have already gotten hit by salt and other places. And if it's your house, it seems like a very different thing than if it's an industry that is doing this on a constant basis. Am I off base in kind of that characterization?
No, I think that's absolutely right. Going back to 1031 exchanges, when you guys had Lee Cooperman on, he was talking about the loopholes that could be closed, and you and Andrew have talked about this a lot, to make the system more fair. Remember, back in the Tax Cuts and Jobs Act, 1031 exchanges were eliminated for every other industry except for real estate. That came under criticism. It is a special carve-out. So many people could say, look, that's an unfair advantage. Step up in basis or capital gains, that's where real estate is sort of becoming a victim, if you will, of a broader tax change, which many people say makes sense, but like you say, could also sweep in inherited property or just families that have owned a property for a generation or two that have increased so much in value, suddenly they're going to owe the tax. So I think the industry will go through piece by piece and try to at least pick out changes and maybe a carve-out for step-up in capital gains, maybe a carve-out for the broader capital gains, or if it includes a property that's been in the family for so many years, then you maybe don't have to pay a tax or a lower tax.
Shepard Smith here. Thanks for watching CNBC on YouTube.